Indian economy is showing some signs of stability. Consumption is picking up. The question really is right now whether growth is sustainable.
Yeah, I think so. Growth is sustainable, mainly because it is not about the recent improvement post-COVID recovery. We have also addressed structural issues. If you look at the banking sector and the corporate sector balance sheets, they both were in bad shape in the second decade. And the bulk of the second decade was spent in bringing them back in shape. And that task is largely accomplished. So basically, capital formation held us back last decade. And capital formation will underpin our growth this decade.
We can't look at India's economy in isolation.
Okay.
There's a very uncertain economic environment. We have geopolitical risks. Oil is a key factor when it comes to India's economy. It imports almost all of its demand. What assumptions are you making about oil prices and the risks from that?
Yeah, look, at the beginning of the financial year in April 2023, Reserve Bank of India assumed an average price of $100 to $105 per barrel for crude oil in the current financial year ending March 2024. And yet they were very comfortable predicting 6.5%. And as we speak right now, the Brent crude is at $85 per barrel, which has the closest similarity to the Indian crude oil basket imported prices. So we are well within the margin of safety where the oil price forecast was assumed to be. So in that sense, as things stand, with the government 10-year bond yield at 7.3 and policy rate at 6.5, and then with a decent monsoon behind us and oil well behaved so far, I think there is not much of a concern about the 6.5% real GDP growth expectation for the current financial year.
You got to wonder what the RBI is thinking. We have oil at current prices with the risk of it climbing. We have the Fed standing pat, but there's a risk it may tighten again. In fact, Axel Weber expects another rate hike from the Fed this year. Can the RBI stand pat? What's the path you think it should take?
I think the Reserve Bank of India cycle has not been so tightly linked to the Fed cycle. Mainly because our external balances and our financial stability are much better than what it was, let's say, 10 years ago when India was part of the taper tantrum countries, the fragile five. So I don't think if the Fed were to hike another 25 basis points or even 2 times, I really don't think that would put pressure on the Reserve Bank of India to follow suit. Because the Indian rupee, if you noticed, among Asian currencies this year has been one of the most stable ones. And given the macro fundamentals, I think RBI does have a few degrees of freedom than before.
But the strong dollar environment is putting pressure. The Indian rupee, you say, is stable, but it is hovering at record lows. Do you think the RBI is comfortable with the rupee at that level?
I think so. Record lows is a matter of nominal valuations, but basically if you look at the percentage moves in the last couple of years, considering the kind of volatility we have seen in global oil prices, global inflation rates, policy rates, etc., India's financial variables, both interest rates and the exchange rate, have been remarkably stable.
We have India on the cusp of an election. Some say that the government, the parties, may be spending a lot in the lead up to that. Might that impact fiscal considerations? It's
a hypothetical question. And at this point, we don't see any indication that fiscal policy is about to be loosened.
So at this point in time, it is not part of your calculations. Is that what you're saying?
No, we are very comfortable with the expectation, given the trends we have seen. This morning you might have seen the goods and services tax data for the month of October, and plus revenue trends in direct taxes and the overall expenditure patterns, including capital expenditure, because until the end of September, first half year, the fiscal deficit is at 40% of its annual estimate, which is very well on track to achieve the 5.9% which we have in place for the union government. And the states are also keeping their fiscal deficit for the current financial year on course to being less than 3%. So we are on track, combined both at the union government level and on a combined basis, to have a fiscal deficit number that is well below what was anticipated at the beginning of the financial year.
We have seen capital making an exit from China, and some suggesting that a lot of it is going to India. What assumptions are you making? How might that boost growth further?
It is at this point, it is conservative not to make assumptions about the numbers that would trickle in, because it's going to be a long-term process. What we are seeing in several sectors, electronics or smartphones or pharma or some consumer durables, a lot of upstream components, production, etc., have moved to India. But for it to become a significant flood, it will take quite quite some time because it's not so easy to dismantle a supply chain network that has taken 2 to 3 decades to set up. So we are not exactly counting on it as a matter of base case scenario, but we are working towards making sure that we offer investors, domestic and foreign, a predictable policy environment and a growth prospect that will automatically draw in investors.
You say India is not susceptible to Fed movements. It is well protected in a way from the strong dollar. I mean, what's the biggest risk out there for the Indian economy?
I mean, no economy, no matter how strong it is without the prospect of facing some risk which could be well outside the normal ranges. So, for example, if geopolitical developments were to worsen considerably and oil price shoots up well above 100, 105, and the speed and the magnitude both will matter for India. And the second risk is that, global stock markets, particularly the US, have been extraordinarily resilient so far. At some point, if they were to give way and lead to a significant price correction, that will have a spillover effect on many markets, including ours. And given the wide retail participation, it will have a knock-on effect on sentiment, consumption, etc. So at this point, the bulk of the risks comes from potential global developments.